Buying a house or renting? Probably the biggest financial decision you'll ever make. Ask 10 people and 9 will tell you buy, obviously. Renting is just throwing money away. But the other side will say buying is a trap. Hidden costs, maintenance nightmares, you're chained to one place for decades. Renting is freedom. Who's right? I don't trust any of them. I only trust math. So I found 2 people, Alex and Ben. Same money, same start date, one 20-year road. One buys a house, one rents and invests the difference. After I ran the numbers, the answer was not what I expected at all. Let's go. Alex and Ben, both 30 years old. Same company, similar income, about $70,000 a year. They both saved $80,000. They shared the same goal. 20 years later, at 50 years old, have more assets. But they had completely different ideas about how to get there. Alex chose to buy. He used his $80,000 as a down payment, borrowed $320,000, and bought a $400,000 house, 30-year fixed rate, about 6.5%. Monthly mortgage payment, about $2,022. He thought, my own house, no more rent, and the price will go up. How could this go wrong? Ben chose to rent. He put his $80,000 into the S&P 500 index fund. Then he invested the difference between the mortgage payment and his rent every month. He thought, buying ties up too much cash. Transaction costs are huge. Maintenance is a headache. I'll let my money work for me in the market. 2 choices, same starting day. 20 years later, who comes out ahead? The answer might not be what you expect. 20 years later, Alex's house went from $400,000 to what? Based on Zillow's historical data, U.S. home prices appreciated about 3.3% annually over the past 20 years. Call it 3.5% after 20 years, his house is worth about $800,000. After paying off the remaining mortgage, his net equity is about $600,000. Ben's index fund, S&P 500, averaged about 9.75% annually over the past 20 years. Call it 10%. His initial $80,000 plus monthly contributions, total value after 20 years, about $720,000. The numbers are clear. Ben wins, at least in this model, by about $120,000. But wait, does this gap really prove that renting is always better than buying? Hidden between these 2 numbers are at least 6 variables that would completely change the math, and 99% of people comparing renting and buying overlook them. In this episode, we break down all 6 variables, not just who made more, but why they made more and what the trade-offs were. In the first year of owning his house, Alex tasted the sweetness. His house appreciated 3.5% from $400,000 to $414,000, up $14,000. Doesn't sound like much, right? But his down payment was only $80,000. $14,000 divided by $80,000 equals 17.5% return. That's leverage. He controlled $400,000 with just $80,000. For every 1% the house goes up, his equity goes up 5%. Ben, his $80,000 in the index fund market went up 10% that year. He made $8,000. Year 1, Alex made $14,000. Ben made $8,000. Alex is ahead. Alex felt smug. See? Buying is the right choice. But what he didn't realize, leverage is a double-edged sword. Year 2, house prices dropped 3.5%. Alex's house fell from $414,000 to $399,500. He lost $14,500. On his $80,000 equity, that's an 18% drop. Ben's index fund also dropped 10%. He lost $8,000. After 2 years, Alex was flat. Ben was flat. Back to the starting line. Leverage amplifies gains on the way up and losses on the way down. Alex learned that lesson firsthand in his first 2 years. But he didn't give up. He believed that, in the long run, prices always go up. Fast forward to year 5. Alex's mortgage payment? Still $2,022. Fixed rate, 30 years. Ben's rent started at $1,500 in year 1. By year 5, it was $1,800. This matches recent U.S. rent trends. Some markets saw 4 to 6% annual increases. Year 1. Ben's rent was $500 cheaper than Alex's mortgage, but by year 5, the gap was shrinking. Alex thought, most of my payment is interest, but at least it's fixed. Ben's rent goes up every year. Ben was doing his own math. The amount he could save and invest each month was getting smaller. $1,800 rent versus $2,022 mortgage. Only about $200 difference. Less and less money going into his index fund. This is a core advantage of buying mortgage payments are fixed. Rent goes up. Alex's mortgage stays the same for 20 years. Ben's rent, if it goes up 4% a year, will be $3,286 in 20 years. More than double. Year 7. Alex hit a wall. The roof started leaking. He got 3 quotes, all between $10,000 and $15,000. He ended up spending $12,000 on a new roof. That was the biggest expense outside his mortgage. But it wasn't the last. Year 9. Water heater died $1,200. Year 11. HVAC system gave out $7,000. Year 14. Kitchen renovation, $10,000. Year 17. Exterior repaint, $6,000. Minor repairs, about $500 per year. Over 20 years, Alex spent nearly $50,000 on maintenance. Ben? His rental, anything that breaks, it's the landlord's problem. Water heater? Landlord fixes it. Roof leak? Landlord fixes it. HVAC? Landlord fixes it. Ben's maintenance cost, $0. Alex started questioning, if this investment needs constant feeding, is it really worth it? Year 15, Alex ran the numbers again. When he bought the house, transaction costs alone were nearly $20,000, roughly 5% of the purchase price. Loan fees, title insurance, appraisal, attorney, closing costs. Every dollar Alex spent on transaction costs, Ben put into his index fund. $20,000 over 20 years at 10% compound interest, that's $134,000. That's the opportunity cost of buying. And property tax. Alex pays about 1.2% annually, the U.S. national average. On a $400,000 house, that's $4,800 a year. Over 20 years, that's $96,000. Ben didn't pay that. He invested it. Combined, Alex spent over $116,000 more than Ben on costs that didn't build any equity. Every 1% higher interest rate eats away at the buying advantage. Alex realized, my real cost isn't just the mortgage. It's every dollar I put into this house that could have been working in the market. Year 18. Alex's father got sick. He needed cash fast. He wanted to tap into his house equity, but it wasn't that simple. 2 options. 1. Sell the house, but he'd need to prep it, find an agent, wait for a buyer, wait for loan approval. Minimum 1-2 months. If he needed cash fast, he'd have to lower the price. 2. Take out a home equity loan, but that meant going through the whole approval process again, paying new fees. Alex chose to sell. It took him 3 months. After paying off the loan and real estate fees, he walked away with $480,000. Ben? He opened his app, clicked sell, and had $720,000 in his account within 3 business days. No questions, no real estate commission, no waiting. Liquidity, how easily an asset turns into cash. Ben's index fund is nearly as liquid as cash. Alex's house is one of the least liquid assets you can hold. A house is an asset, but it's a sleeping asset. When you need it, it doesn't wake up quickly. Wait. Alex and Ben's story isn't a who won answer. It's a framework for how you decide. In real estate analysis, there are two simple rules of thumb. First, the 7 to 9 year rule. Zillow data shows that in today's market, the average homeowner needs to stay 7 to 9 years for buying to beat renting, and in expensive cities like San Francisco or New York, it's 15 to 20 years. Just a few years ago, the rule was 2 to 3 years. Simple rule. If you're staying less than 7 years, renting almost always wins. If you're staying 10 plus years, buying typically wins. Second, the price to rent ratio. Take the property price and divide it by annual rent. If the PR ratio is below 15, buying clearly wins. If it's above 20, renting is more economical. Apply this to Alex and Ben. Alex's PR ratio was about 18. Borderline. With a 6.5% interest rate and higher transaction costs, he needed 15 to 20 years for buying to really pay off. He held for 20 years. So, Alex won. Just in a different way. He didn't win on cash flow, he bled money into that house every month. He won on wealth accumulation 20 years later. He has an $800,000 asset. It's illiquid, but it's real. Ben won on liquid wealth, $720,000 in his account, accessible anytime, ready to be deployed. Now let's recalculate everything. Alex's final asset, home value after 20 years, $800,000. Remaining mortgage balance is approximately equal to $200,000. Net equity, $600,000. Minus maintenance, $50,000. Minus transaction costs, $20,000. Minus property tax, $96,000. Alex's net gain is approximately equal to $434,000. Ben's final asset, index fund value after 20 years, $720,000, minus small trading fees, is approximately equal to $5,000. Ben's net gain is approximately equal to $715,000. On pure numbers, Ben still wins by about $281,000. But does that mean renting is better? No, because Alex didn't buy a financial product, he bought a home. Over 20 years, Alex could hang pictures on his walls without asking permission. Alex's kids attended the same school district for 15 years. Alex was never told to move out. Alex never had to pack up and move when a lease ended. Ben moved 4 times in 20 years. Each time, energy, emotion, money matters. But not everything can be turned into a number. Alright, that's Alex and Ben's story. This isn't an investment advice video. It's a help you see the trade-offs video. 6 variables across 2 people's 20-year journey. 1. Leverage amplifies gains up, amplifies losses down. 2. Fixed versus floating mortgage is fixed. Rent always goes up. 3. Maintenance. The older the house, the more it costs. 4. Transaction and opportunity cost. Every dollar you put into buying is a dollar not compounding in the market. 5. Liquidity. Your house is valuable, but it doesn't cooperate when you need cash. 6. The 7-9 year rule and PR ratio, how long you stay, determines what you choose. Buying and renting, neither is objectively better, but one fits your stage of life better. If you're willing to put down roots for 10 plus years, buying can be a powerful wealth tool. If you prefer flexibility and liquidity, renting plus investing is a very smart choice. Choose the price you're willing to pay, not the one that looks like it makes the most money. Speaking of choices, have you ever noticed that debt is a completely different thing in different countries and different generations? In America, student loans are just part of life. In Germany, college is free, student debt barely exists. In parts of Asia, a mortgage is a lifetime commitment. In Europe, renting into your 60s is totally normal. Same word, debt. Completely different math. Same formula, compound interest. Completely different choices. Next episode, we run the debt math across 5 countries. You might realize that what you thought was the right choice might just be what your country made you think was the only choice. I'm Gino. See you next time.